welcome to TradeTheBear.com. My name is Stacy, and I'm going to take the opportunity today to talk to you about basic options. What are calls? What are puts? What is a bid ask? What is in the money, at the money, out of the money? What does it mean when we say an expiration? What is the strike price? What is the intrinsic value of a particular option? What is the extrinsic value? What is open interest? What is delta? Today we're going to be talking about using options for directional strategies for the most part. So that means we're going to expect the market to either go up or down, and we're going to be buying calls or buying puts, which means that if I buy a call, all right, so options can work in all markets, okay, but when you're buying a call, you're expecting the market to go up. If you are selling a call, you are expecting the market to go down. So I've put up in an option chain here to kind of explain what it is we're really talking about. So here's our calls on this side of the option chain, and here's our puts on this side. So we have our different columns here, which here's our bid and our ask. So this is, if you put your mouse over this, you can see, well, hold on. You can see this turns into a sell. So that means I'm selling the call. If I'm on the bid, I'm looking at what the sell price is at. If I'm looking at the ask, I'm looking at the buy price. So we can see right now the spread between the bid and the ask is $3.75 versus $3.77. So why do they have the term call or put? So if you're buying a call, what you're doing is there's two parties involved. There's the owner of the stock and you as the buyer of the option. So the owner of the stock is renting to you the use of the option for a given period of time. So you're renting that stock, paying that person a premium to be able to do that. So that is the basics of options at its core. And so if I buy a 272 option, okay, then that expires in June, that means that I'm buying that call for the duration of time, 30 days, to be able to use that option, hoping that I am right on what's going on in the price of the underlying, which is which is the stock price. So a call up market, if at any point in time this person can call away the option, so basically they can give you the option, or they can give you the stock for the premium that you paid for the option at any given point in time. And then that's called being exercised. Now, being exercised doesn't happen very often. You do not need to worry about that with this example, but that's what call away would be. And then put to. So I can give you the stock for, again, that premium that you paid for it. So that's where the terms come from. But don't get too wrapped up in expirations and worried about all that and so forth. Now, the other instrument that we have, or what we call our spreads. So that's a way to use a combination of calls and puts. So you could buy a call, sell a put. You could buy a call, sell a call. I mean, there's different ways that you can set up spreads. Don't worry about that. We'll get into that later. But today I just want to talk about the basics of calls and puts and what we see in an option chain. So when you're reading the option chain, so let's say we opened up our account, right? And so we're opening it. We usually have the monitor here. This is Thinkorswim that I'm talking about. So I'm going to go to the trade tab. And when I do, I'm seeing all products. And you see down here the option chain. So if this was collapsed, it would look like that. So what we do is we're going to open up the option chain. Now, what you see here is the expirations. These are the days that these expire. So this is considered a monthly option. Every monthly option closes the third Friday, trading Friday of the month. So that is June 15th is 30 days away. So we're going to be talking about the June 15 expiration, meaning these options expire on June the 15th. So the bid and the ask, this is the buy and sell range. So 375 to 377, I've frozen this in time. So we're using on demand. So I'm going back in time to 2018 on May 16th at 1 o'clock. This is my time. So this is what, Mountain Time? And so we have about an hour, 55 minutes left before the market closes. And I've paused it just so that it makes it easier to talk about. But if we were to run it, we would see things moving, we'd see these moving back and forth, and we would see, all of this happening. So the bid ask is the price between the buy and the sell for the strike price, which is, these are your strike prices here, which you can see up here at the top. So the 272, which will be, when you see this little yellow line that's in the money, at the money, I'll explain that here in a minute too. But so anyway, this is the bid and the ask, 272, June 15th expire. So if I were to click on this, it would bring up a buy, 3 contracts. I got it set for 3 contracts. SPY, June 15th, 272 strike for 377. All right, I'm going to delete that because I wouldn't buy that right now. So anyway, so it's 50, or anyway, I'll get into that in a minute, not the 50 delta. But all right, so the bid ask, that's the sell and the buy range, in the money, at the money, or out of the money. You'll hear ITM, ATM, or OTM. So in the money is everything that's highlighted in yellow. Out of the money is everything that's highlighted in white on this particular chain. And then your at the money is usually this core right here. Okay, so that's going to be where it's close to trading to. Now, let's get into some complicated stuff. Oh, one more thing about bid, ask, and then the last. This is the last traded amount that it was traded for. Okay, so if you take the intrinsic value is the value between the stock price and the option price. So basically, if you're at 272, you add 33 cents, and you're trading at 272.33. Okay, so that is going to tell you how far you are away from being, completely purist at the money. That's your intrinsic value. So how does that help you? Well, if you notice, here's your extrinsic value. Now, extrinsic value is what we would call time value. So as we go further along in time, let's go up here and look at the 272 here. And you can see the 272 here is $1.18. So its extrinsic value is 86 cents. So 86 cents plus 33 cents is going to equal approximately where this is trading at. Now, the difference, if we bought this for $3.75, we can go up here and we can see 2 days from expiration what the value would be if everything stayed the same. So this is, you can see the time value. See how it shrinks? It goes from $3.43 down to 86 cents. So if the price stayed exactly the same, didn't make a move, you would lose 343 minus the 86 in this trade. So we really want to see this stock make a move in the upward direction. So that's extrinsic value. I'll look at it. Notice something here too. If I'm at $3.43, this tells me which option is most attractive. So usually a 50 delta, 50 delta, which I'll get into here in a minute, is where the market is trading at the current point in time. So $3.43, that's higher than the 309, higher than the 315. So this is the most attractive right now, okay? Now, the next thing we need to understand is open interest. That's how many open contracts that are in that particular, sort of the 272 strike, June 15th expiration, there's 30,391 contracts in play. Now, why is that helpful? Well, that's going to be helpful to tell us if, which one of these is traded more heavily. Well, of course, this 147,582. There's more options there than there are at the at the 270, which that's what, 275. So the 275 has a lot of open interest. The 270 has a lot of open interest. So that can sometimes help you in your trading, but you want to make sure that you have open interest before you put a trade on. The beautiful thing about trading the SPY is no matter how far out in time we go, let's go out way out here. You can see we still have open interest even on something that's 300 days out. So open interest is your friend. Try not to trade anything. If you trade zero interest, zero open interest, you're the only guy in there, and you're the only one that is possibly going to be on the other side to make that trade. So that's open interest. Now let's talk about delta. I brought it up a little earlier, and in this column it's reading zero because I'm looking back in time, but there is a way on demand to be able to look at delta. So we'll go over here to analyze, and we'll make sure that we set this to, we want to go to think back. So I'm going to go look back in time to see what the delta is, and we're going to go to the 5/16, same date, 2018, and then we can see our delta. So on the call side, you have a 50 delta, you have a 70 delta. So what does that mean? That means for every dollar that the stock moves, the option's going to move 70 cents. So you're going to see 266 goes to 267, and you're going to be able to probably take that plus that equals that, real close, something to that effect. So you want to see, that gives you an idea. If you're buying at the money, the 272 option, and you're paying 360, no, that had 362, 367. This is at the end of the day, by the way, that captures it. So that would put you, so let's go back to our trade tab. So this is how we can tell if we want to go completely in the money. We would go, you can see, to get to a 1 delta, it's almost impossible. See how it kind of blows out. But that's just kind of a rule of thumb. It's going to move that many cents for that. Now, same thing over here. As you can see, as we increase on the put side, okay, so the put side, the deltas are going to be more. So as you hear me talk in videos, you'll hear me talk about delta. You can always relate back to this video to understand what we're really meaning. To look at an example of buying a call, and I decided to do this in real time. I know we were looking back in time. What I wanted to do with the video was to show you what options normally look like, and then we can come into real time and I can show you right now with the VIX as high as it is, implied volatility is really high. So options are expensive when the premiums are inflated greatly when the VIX is really high. And you'll see that as we go through this example. So here we are, we're looking at the SPY. And let's just say we were going to take a long position using the close of this high, which is like 278.20, and the low is 265.25. Okay, now Thinkorswim has a cool little tool where, let me go to all, let's see. So we're gonna, we can see that our delta, we want to use like a 70 delta. Let's just say we're going to go a little bit in the money, and we're going to go with a 70 delta. So you can see here, here's our delta right here. So there's a 70. So that's going to put us at a 262. So for $24.08, we can buy this particular call. Now, how do we determine how much risk we're going to have on this trade? So there's a couple of ways to do this. We could take the 278, this is a shortcut, 27, and we could subtract that from the low here, because that's going to be our stop, 265.25. So that gives us $13.02. Am I right? 278.20 minus the low, 265. Oh, I think I did that wrong. 278.20 minus the low of 265.25 equals 1295. One more time, because I got different math when I did this earlier. Minus 265.25. Okay, so that's $12.95. If we multiply that by our delta, that gives us $9. So we could conceivably take the $9 and take our risk. Let's say we're doing a $50,000 account. 2% of that would be what, $1,000? So we'd take the $1,000 and divide that by 9, and that would be 100 contracts. So we could buy one contract that way. All right, but let me show you another way that Thinkorswim makes this work for you. You see down here the expected price of SPY. So that says 278.97, which is a little high. But if let's say we drop this down $9 to, oh, what are we going to be, 15? So you can see we're real close, 266. So let's go. Let's see if we can get it right on the nose. So there we are at 1482. So if this price was to go to 265.75, the option premium would be $14.82. So if we take the 24.08 minus the 1482, we've got $9.26. So we're really close to the example that I showed you by using the delta. Now the other thing that we can do is we can look at this on a graph. It's called an Analyze tab. So let's bring this up and we'll do Analyze Trade. And we're gonna set it for May the 15th because that's when the option expires. Let me get, I had this already in here. And let's take this down to one contract. So if we have one contract of the May 262, this graph will tell us where our break even is. So we need to be at 276.79 to break even. Is that correct? That would be our zero line. So to break even, we're going to have to be up here closer to this dotted line, which is 278.97. And if at the expiration, we're way over here, say 306.74, then we'll pull in about $3,000. But our maximum, this will show us our maximum loss down here of somewhere around $1,500. So you can use this to help you understand the trade. You can also go back over here. You can also use this, the expected price, to determine where you're going to be as far as how much risk that you put on in the trade. So if we were to put that on right now, one contract at $24.08, our cost would be, what would it be? 24 times 100. Oh, $2,408. All right. Now, if we were to buy the stock outright, and let's say we were getting 278.97 times 100, we would be paying about $27,897. So this allows us to leverage, again, this particular opportunity to make us some money. So hopefully you can see how that works. And of course, we would want to see this going in the upward direction. Just one more thing to do before we leave this video. Let's look at it on the put side. Same thing. So let's say we were to buy a 70 delta put. So that's going to put us right in this area. We were to buy that. Drop this down to one contract. And we can do the same thing on the Analyze tab. Also, there's a curve for another day we'll talk about. But so here's your put. So if it drops down to make $3,000, we would need it to go to 243. And of course, our maximum risk is basically the same on the other side. About the same on the other side. So give or take a few. So you can see how the graph changes when we do those two things. So we'll be using these graphs a little bit as we learn more about options. And please comment down below and subscribe to our channel and subscribe to our website and be a part of the Trade the Bear team. Thank you.